Should I pay points to get a lower fixed mortgage rate? Imagine this. You're about to buy a home and you see two mortgage options. One has a slightly higher rate, but no upfront costs. The other offers a lower rate if you pay some money at closing. What should you do? That's what paying points is all about. Paying points, also called discount points, means paying an upfront fee to your lender to get a lower fixed mortgage interest rate. Usually 1 point costs 1% of your loan amount. For example, if you are borrowing $300,000, 1 point would be $3,000. Paying that might lower your interest rate by about 0.25%, but this can vary depending on the lender. Lenders see points as prepaid interest. When you pay points, you're giving the bank some money upfront in exchange for a lower rate over the life of your loan. This benefits lenders because it reduces their risk. For borrowers, paying points makes sense if you plan to stay in your home for a long time. A lower interest rate means your monthly payments will be smaller, and you'll pay less interest overall. But if you plan to sell or refinance your home within a few years, paying points might not be worth it. The key thing to think about is the break-even point. That's the time it takes for your monthly savings to cover the cost of the points. For example, if paying $3,000 in points saves you $50 a month, it will take about 60 months or 5 years to break even. If you stay in your home longer than that, you'll save money. If you move or refinance before then, you might lose the money you paid upfront. Another thing to consider is your ability to pay the extra closing costs. Paying points increases your upfront expenses, so make sure you have enough saved. Also, think about how long you plan to keep the mortgage. If you're planning to stay in your home for 10 or more years, paying points can be a good move. But if you're unsure or expect to move sooner, it might be better to choose a higher rate without points. Many banks and credit unions have tools to help you compare these options. They can show you the total costs with and without paying points. Some lenders even offer different point options, so you can pick what fits your budget and plans best. Remember, paying points is a personal decision. It depends on your financial situation, how long you want to stay in your home, and your comfort with upfront costs. So, should you pay points to lower your fixed mortgage rate? If you plan to keep your home for a long time and can afford the initial expense, paying points can save you money in the long run. But if you're planning to move sooner or want to keep your upfront costs low, it might be better to go with a higher rate and no points. Always use a mortgage calculator or talk to your lender to see what makes the most sense for your situation.